Hey, everybody, and welcome back to another episode. Today, I'm excited to have Erik on the show. Erik was an operations manager for a multi-million-dollar landscaping and design firm in Long Island, New York. Since heading west and joining Cost Segregation Authority, Erik's been speaking at local, regional, and national events. He brings with him a passion for identifying cost savings and educating commercial real estate owners on the benefits of cost segregation. I have not had somebody on the show that does cost segregation. Here, there's some energy credit stuff that everybody needs to know about. Everybody likes free money. So this is going to be a fun episode. Erik, welcome to the show.
Thanks, Brent. I'm excited to be here.
I'm excited to have you. This is going to be fun because I have not personally utilized this vehicle myself. I've done a poor job of that. We don't do a ton of commercial, but I'm starting to get into it more to diversify out of residential. So I want to get into the cost seg stuff. But before we jump into the meat and potatoes, why don't you tell the audience a little bit about your background and how you got to what you're doing today?
Yeah, no, that's a question my kids ask me all the time. They're like, Dad, how did you get into cost seg? First, they ask, what is cost seg? And then I try to explain it to them. They're like, Dad, how did you even find that job?
Yeah.
So kind of just my background. So my background is in accounting. So I have an accounting degree. I'm not a CPA, just have an accounting degree. Found this job. I had moved to New York for about 5 years. I was born and raised in Salt Lake, moved to New York for 5 years. And then it wanted to get back to Salt Lake. So my parents were getting older, wanted to come back to Salt Lake. We'd had a couple kids and was looking across the jobs here in Salt Lake and came across this job. I'd always been interested in real estate. I wasn't an investor at the time, but with my background in accounting and in business development, I thought, what a great job. And so I actually had to look up what cost segregation was when I first applied because I wanted to make sure I was prepared for the interview. As I was looking it up, I realized, wow, what a great opportunity to help save people tax money. And so that's kind of what brought me to Cost Seg Authority. I've been doing it for about 7 years now. Kind of my role within the company is to educate both investors and CPA firms on the benefits of cost segregation. You'd be surprised, Brandon, how many CPAs have heard of the term but don't really understand what it is or how it applies. And so that's part of what my role here is at the company, is just getting that word out, educating, providing those educational classes to both investors and CPAs.
So let's start there. What is cost segregation for those that maybe are just hearing it for the first time, and how can they use it to their benefit?
Yeah, cost segregation really is just accelerated depreciation on your real estate assets. So let's take a step back. Let's just talk about what depreciation is for those listeners who don't understand depreciation. But depreciation is a non-cash expense. So you've got your income, you've got your expenses, and whatever's left over is your taxable income, and that's what you get taxed on. And depreciation is one of those expense lines. And so the government says when you buy a piece of revenue generating property, like either a residential rental or a commercial building, you get to depreciate that over time because it deteriorates over time. And so residential units are typically depreciated over 27 and a half years, and commercial units are depreciated over 39 years. So just to make the math easy, let's say you buy a $390,000 office condo. Essentially, you take that $390,000, divide it by 39, and you're going to get a $10,000 write-off every year. Mm-hmm. What that means to me as an investor is if, let's say, I make $100,000 of income every year, instead of being taxed on $100,000, I now have this $10,000 expense. So now I reduce my taxable income from 100 down to 90, and now I'm only being taxed on 90,000. And so that's depreciation. That's called what we call straight line depreciation. What cost segregation is, hey, we say, well, listen, I might not own my building for 39 years. That might not be part of my investment strategy, right? I want my deductions now. And so how can we front load, instead of taking 1/39th of a deduction for the next 39 years, how can I front load some of those deductions and get them in the earlier years? And the way you do that is through an engineering-based study where when you buy an office building, you're not just buying the land and the walls, you're also buying some flooring. You're buying a parking lot. You're buying some signage. You're buying cabinets, countertops, etc. All those items I mentioned, according to the IRS, they don't last 39 years. Carpet, for example, is a 5-year asset. Carpet should be depreciated over 5 years, not 39 years. The challenge with that, Brandon, though, is you buy this building for $390,000, you give that closing statement to your tax preparer, Your tax preparer has no idea what the value of the carpet is in the building. They just know you bought all that stuff for $390,000. And so a cost seg study goes in, just as the name implies, we segregate the costs into different buckets, 5-year bucket, 7-year bucket, 15-year bucket. And that allows your CPA to depreciate a portion of that building over 5 years versus spreading it out over 39. So we're front loading or taking the depreciation in the earlier year.
So it all boils down to the lifespan of all of the individual materials that make up that purchase. So you're going to be able to, the lifespan of being able to depreciate, say the siding of the building is going to be much different than the carpet, because the carpet doesn't survive as long. It gets replaced much more often.
You got it. So the IRS has a really, I don't know, it's thousands of pages that basically tells you the useful life of almost every asset that you can think of. The problem again, though, is when you buy that, you and your tax preparer don't know the value of all those different components. Again, you just bought all this stuff for, $390,000. And so we come in and we say, okay, of that $390,000, the parking lot's worth $42,000. Your flooring is worth $8,000. Your appliances are worth, $6,000. We put a cost to all those and have all the backup documentation to allow you. Your parking lot, for example, lasts, according to the IRS, the depreciable life is 15 years. And so you should be depreciating that $60,000 parking lot over 15 years, not 39 years. And so, yeah, we just come in, put a value to all those different components and provide our deliverable is a revised depreciation schedule that has everything line itemed on that depreciation schedule and the useful life. And that way your CPA can depreciate them correctly.
Okay, I see. So you're able to pull it is a kind of like a collective whole. It's $10,000 per year based on a $390,000 purchase, but there's some items with a much shorter life than 39 years. And so you're able to take those items and pull those to the front and use that to offset any income that you would make with that commercial property.
Yep. Not even income just on that commercial property, but oftentimes income on any of your properties. So that's a great point that we should probably address is typically real estate, depending on if you're a real estate investor, you've probably are familiar with that term, being a real estate investor for tax purposes. Normally, I'll give my example. I'm a W-2 employee here at Cost Seg Authority, and I own some rental properties on the side. When I do cost segregation on those rental properties and I create those deductions cannot be used to offset my W-2 income because those are considered passive deductions and my W-2 income is considered active income.
Yeah.
So you can't use passive deductions to offset active income. It has to be active versus active or passive versus passive. So in my case, I can use my deductions from my real estate to offset income from my real estate, but not my W-2 income.
Yeah.
And then, so that's just something to keep in mind. So cost segregation isn't for everybody. If my rental properties don't make a ton of money each year, it doesn't make sense for me to create this $80,000 deduction if I'm only making $8,000 of income, because then it's going to take me basically 10 years to use that up, right?
Yeah.
And so just something to point out, it's not for everybody, but you've got active versus passive that you want to address when looking at.
So the depreciation doesn't count on your income or against your income for a W-2 job that's coming from being a doctor or lawyer or whatever.
Right.
But if you are a real estate professional status, in other words, if you do real estate for a living, like I'm a real estate professional, so I get all my active income comes from real estate, I can then use depreciation for my active income that I receive for all of my real estate projects if I'm set up, in the right tax vehicles.
Yep, you got it. And not only that, if you're married and you file a joint tax return, then all of your spouse's income, even if your spouse is, let's say, a teacher and works 40 hours a week at the school district, as long as you guys file a joint tax return, because you're an active real estate professional, those deductions, that real estate deduction can also be used to offset your spouse's W-2 income. So that's one way to get around it. That's why oftentimes you'll see like high W-2 earners, like doctors, maybe they're fortunate enough that their spouse stays home because they have high W-2 income. If the spouse can qualify as a real estate professional, then you can use those deductions from your real estate to offset the high W-2 doctor income because they file a joint tax return.
They're filing jointly. Interesting. Okay, so there's a little loophole in system.
There's some ways around it, but yeah, that's kind of the basic principles.
Now, I've got a commercial property that I think we're going to be putting on the market here pretty soon. That I mean, it needs probably $120,000 worth of work, right? It is not actively being leased out, right? It's vacant. You know, I got it on owner financing terms, and I'm just kind of sitting on it, hanging on to it. What would be the depreciation there? I mean, it needs a lot of work. Is there any opportunity for depreciation, or does the depreciation really only kick in when you're, installing brand new stuff?
No. So, couple questions. When did you buy the building?
3 years ago.
Okay.
Let's hang on. 2019. When was that? 4 years ago.
Okay. So 2019. And was it always vacant? Has there ever been anybody in there leasing it, or has it always been vacant?
I bought it vacant and just have hung on to it.
Okay. So typically, in order to take depreciation, you have to have the building has to be in service. So in service is kind of a vague term. CPAs, tax preparers will all look at it a little bit differently, but basically the IRS's definition of being in service is available for its intended use or purpose. So if it's an office building, but you've got it gutted down to the studs, then obviously you can't put people in there in its current condition. Right. So that would not be in service or available for its intended use or purpose. Now, if you've got an office building and maybe it's just a little bit run down, but it's functional. If you wanted to lease it, you could lease it. And maybe you've tried leasing it, you just couldn't find a tenant. You may be able to qualify that for being in service. That would be a call for your CPA, but you can't take any depreciation unless the building is in service. And so that's kind of my guess is that building has probably never been placed in service by your tax preparer. Mm-hmm. So you probably haven't taken any depreciation on that building. And if you're looking to sell it, you won't take any depreciation on it because it was never used for its intended use or purpose.
Yeah. So let's talk about the sale aspect of it, because
Sure.
I know this depreciation comes back. So, let's say you buy it for $390,000, you can take an $80,000 write-off up front through doing let's say they hire you, you do a cost seg study and go, hey, look, good news, we can write off $80,000 worth of stuff in year one, which means you're not going to pay any money on what you made income wise on it. So you saved a buttload of money in taxes. And then a year later, they decide to sell it. What happens? Because I know there's a recapture of that depreciation.
That's a great question. So that's a question we get asked most often by tax preparers is, Eric, isn't this just a timing issue? If I take all these deductions up front, by taking depreciation up front, it increases your capital gains and your recapture tax on the back end.
Yep.
And so they said, hey, if I take all these up front, I'm just going to have a bigger tax bill when I sell it.
If you don't wait it out.
If you don't wait, yeah. And that's not necessarily true. So the idea behind cost segregation is you're taking your deduction this year against your ordinary income. So let's say you're in a 37% federal tax bracket. You're taking your deduction against income that's being taxed at 37%. If and when you sell it, you're going to pay it back or a portion of it back at a capital gains rate of 20% or a recapture rate of 25% and save the spread. And you don't actually pay it all back, you pay some of it back. And I'll back into this example, Brandon, because I think it's a little easier for the listeners to understand.
Yeah, that was kind of hard for me to understand. Give us an example, because I think this
will clear it up, I think. Let's say you buy a building for $1 million.
Right.
You sell it 5 years later for $2 million.
Okay.
When you go to settle up with the IRS, you're telling them that everything has doubled in value, right? I bought all this stuff in this office for $1 million. Right. I'm selling all this stuff for $2 million. And so they're going to charge you tax on that $1 million of gain.
Yep.
Well, my walls have gone up in value. They've doubled in value. My land has doubled in value, but my dirty, nasty carpet that's 5 years old certainly hasn't doubled in value. If you don't do a cost segregation study and you've got everything lumped together, you're saying all this stuff was bought for $1 million. I'm selling all this stuff for $2 million, and they're going to tax you on that. When you segregate it out, carpet, if you remember, Brandon, I said carpet earlier was a 5-year asset. Mm-hmm. What is the book value of your carpet after owning it for 5 years? Zero. Has zero value. It's fully depreciated. So when you sell that carpet in year 5, you should be selling that carpet for zero and paying no tax on that gain, because there is no gain. Why would you sell your carpet for more than you bought it for 5 years ago when it's dirty and stained and old? Carpet doesn't appreciate. Carpet goes down in value. Mm-hmm. Your land appreciates and your walls appreciate, but your carpet goes down in value, your appliances go down in value, your cabinets go down in value, all those things go down in value. The problem with not doing a cost seg study is when you sell that asset, you can't pull that carpet out of that sales price.
Mm-hmm.
You just have to, again, say, hey, I bought all this stuff for $1 million. I'm selling all this stuff for $2 million, and you get charged tax on that. Well, again, your carpet shouldn't be doubling in value. Your carpet's worth $0 after owning it for 5 years. So in summary, in your example, where you're only buying it for a year, take your deduction at a high rate. It's going to be going against income that's taxed at 37%, pay back a portion of it at a lower rate at a future date, and you're saving that spread. So I don't know if that cleared it up, or recapture is kind of a tricky one, but hopefully
that makes sense. So
visual.
you're buying it for $1 million, and let's say you can write off $200,000 of depreciation in year one and kind of pull it, but then 5 years later you sell it, you take into the account what you've pulled forward, and you're going to have pulled that forward, but the years will reduce that depreciation that you recapture because you're
Right.
living through the life of the depreciation. And then when you sell it, you're looking at, okay, what depreciation do I have left on this, if any? What's the true value worth? And your example, you said the carpet, if you sell it 5 years later, carpet's not worth anything. So you can write that off against your $1 million taxable gain.
Exactly. Yep. That 200,000 of depreciation that you took, let's say you took that 200,000 on just carpet, that 200,000 of depreciation you took, there's $0 recapture upon sell because that carpet has $0 value. Now, if you were to sell that carpet after owning it for just 1 year, let's say you had $200,000 of carpet, you take that depreciation and then you sell it a year later. Well, you do have to recapture 4/5 of that essentially because you've only depreciated 1 out of the 5 years. So it's not down to 0. You've only depreciated 1 out of the 5 years. So you still have to pay back 4/5, but you're paying back that 4/5 at a 25% rate, and you're taking your deduction at a 37% rate. And so you're saving that 12% spread.
Makes sense. Is this just for commercial, or can single family residential properties do this as well?
So all revenue generating properties, cost segregation is available for anything from a single family rental all the way up to large office buildings.
Okay.
Now, in the example we just walked through on smaller single family rentals, you do want to hold them for a longer period because that rate arbitrage, or that difference between taking your deduction at a high rate and paying it back at a lower rate, that difference on a small property, like on a $200,000 property, that might save you $3,000, but a cost seg study is going to cost you $3,000. So it doesn't always make sense. We want to make sure, because all you're doing is you're taking advantage of a rate arbitrage, and the rate arbitrage on a small number versus a big number is going to be significantly different. And so I found on the selling side, if you're only going to hold it for a year, it probably doesn't make sense to do cost segregation on any asset that's less than $500,000 of depreciable basis. Anything over that, it always makes sense. And if you plan on holding your let's say you buy a $200,000 single family rental, you plan on holding it for 5 years, you're definitely going to want to do cost seg because again, you're going to reduce the amount of recapture tax you pay by segregating out those assets.
Makes a lot of sense. Let's move on to energy credits, because I know that it's been a hot topic, especially with the current presidential administration, right? Very, very green, pushing more towards energy efficient. There's a lot of talks about carbon credits, and not many people are up and up on the laws and how things are changing and how the incentives are working towards moving to this more energy efficient model. I mean, tell us some of the opportunities that are out there right now for, real estate investors to really capitalize on, what the administration is doing.
Sure. No, that's a great question. Remember that the IRS, the government, they use the tax code to incentivize us to accomplish whatever it is they're trying to accomplish. So like you said, they're pushing green energy. So they're going to incentivize us to build buildings that are energy efficient. And so there's 2 credits that go extremely underutilized in our industry. The first one is something called the 179D deduction. And the 179D deduction is for It's a deduction that you may have available to you if you construct new commercial real estate that's deemed energy efficient.
Mhm.
So if I build a new office building, I have to have a third party come out. They're going to look at things like the insulation, the windows, the lighting, the HVAC, those types of things. If it meets a certain threshold, then you may be eligible for anywhere from a $2.50 deduction per square foot all the way up to a $5 deduction per square foot on a sliding scale. So, again, mainly for new construction, it does work on leasehold improvements if you're making significant improvements to an existing property.
Mhm.
But most of the time, it's on new construction, commercial real estate only. And it's anywhere from $2.50 all the way up to $5 deduction per square foot.
Mhm.
So remember that deduction comes off your taxable income. So it's just a
Right.
free deduction that's available to you if you're constructing energy efficient buildings.
So I've got a 2,000 square foot commercial building, and we would rehab it. Let's just say we're building it though.
Yeah.
Sounds like the max deduction I could get, at $5 a foot times 2,000 square feet is about $10,000.
Right.
So what do you know? I mean, are you able to speak to what the construction requirements are that would go into receiving that credit? In other words, I'm kind of like, what are the additional items that would have to be done between a normal construction and an energy efficient construction? Because as a developer, I'm going to weigh the cost, right? I'm like, cool,
Right.
if it's less than 10 grand, let's do it. If it's more than 10 grand, well, why would I want to do this?
No, that's a great question. And there's a number of things that will impact the energy efficiency of a building, even things like which way the building faces, which direction. Because if you've got a bunch of windows on one side of the building and the sun is always coming in that side, then you're going to be running your AC more often than others. So they're looking at everything from the direction of the building. But the three big factors when running these deductions or these deductions is going to be the insulation. So you've got to put in a certain rating of insulation. And so again, it becomes a financial. Now, they all work in conjunction. So even though you have great insulation, if you've got a low efficiency HVAC unit, you might not qualify. So there's not like you get a piece of the deduction if you put in R21 in the walls. It's not how it works. It's got to be as a whole. So we've seen people that put in really efficient HVAC units, but then they go cheap on the insulation, and unfortunately they don't qualify. But it's the insulation in the attic and in the walls, it's the ratings of the windows, it's your HVAC units, it's your lighting, and that's typically the 3 or 4 biggest factors that go into this. And in saying that, Brandon, it's with the construction or the building codes that are out there by most counties and the materials that are being used, it's pretty hard not to qualify because most everything that's being built now is a lot more efficient than it was in the past, just because, like I said, of the building codes, the stricter building codes and the materials. And so you really have to build something inexpensively in order for it to not qualify. But the problem is a lot of people don't even know this deduction even exists. And so they just don't take advantage of it. But that's what we're trying to do is just get the word out because, again, most of these buildings will qualify based on those 2 factors.
Wow, this is huge. Well, all right, so we've done a deep dive on both cost seg and energy credits, and it's free money out there, and this isn't going away, right? We're moving towards a more efficient energy model world, and the tax incentivations are not going to slow down. Erik, this has been great. If people want to learn more about, maybe hiring your firm for a cost seg, learn more how to do a cost seg, maybe get some more information, where should they go?
Yeah, the best place to get a hold of us is just our website. It's just www.cost, C-O-S-T, seg, S-E-G, authority. My contact information's out there. We'll always do a free benefit analysis before we ever engage somebody. We want to make sure you're going to save significant tax dollars before you pay us a dime. So get a free analysis run. If you've got any revenue generating properties with a purchase price of about $300,000 or greater, definitely worth looking into because you might be leaving some tax dollars on the table if you're not taking advantage of this. The tax law is very favorable right now. One thing we didn't touch on, Brandon, is bonus depreciation, but with the Tax Cuts and Jobs Act, I don't know if you recall that at the end of 2017, the beginning of 2018, Donald Trump was our president. Donald Trump owns real estate, and Donald Trump revised the tax code. And so it basically put cost segregation on steroids and made the benefit even greater. So if you got properties anywhere from, like I said, $300,000 purchase price or greater, definitely look into getting a study done and seeing if you might be able to save some significant tax dollars.
So let's jump into this. So bonus depreciation, what is that? What did Donald Trump do? Because I know that we're kind of in this step ladder mode where the incentivizations that were put in place with real estate, it's kind of stepping down, right? I think it was like 100% this year.
Yep.
It's like you can take up to 80% depreciation. I think next year 60% and then 40%. Sure. You know, speak a little bit more to that. What bonus depreciation is and kind of what's going on currently with it.
Yeah, no, bonus depreciation, like I said, basically puts cost segregation on steroids. Bonus depreciation has been around long before cost segregation as basically a way to stimulate the economy. So they say if the bonus percentage was, let's say 50%, they would say, if you go out and buy $1 million bulldozer, we're going to let you take 50% of the depreciation in the first year. The other 50% gets spread out over the useful life of that asset. Mm-hmm. So in real estate, when it was 100% bonus, which it was, any assets placed into service between 9/27 of 17 and 12/31 of 2022 were eligible for 100% bonus. So what that means for real estate investors is when we do our cost seg study, in order to take bonus depreciation, it only applies to assets that have a useful life of 20 years or less. So if you remember, residential units are 27 and a half, so they don't qualify. Commercial is 39, so it doesn't qualify. But when you do a cost seg study and we take that residential unit and we break it up into 5, 7, and 15-year buckets, all of a sudden those 5, 7, and 15-year assets do qualify for bonus. So in that example where we talked about a $60,000 parking lot, let's say you've got a fourplex and we determine the parking lot's worth $60,000. Instead of taking that parking lot and dividing it up over 15 years, because a parking lot is a 15-year asset, when you take 100% bonus, you get 100% of that 60,000 all in year one. So in the current
your write-off,
all of your write-off in year one. In the current world we live in 2023, where bonus is at 80%, in that parking lot example of $60,000 parking lot, you would get 80% of that, or what's 8 times 6? 40. Let's see. I'm trying to do the math here in my head.
Somewhere around like 50-ish thousand, 52,000, something like that. Now I get it.
Yeah. So you 48 of that $60,000 parking lot, you're going to get 48,000 of it in year one because you're getting 80% of that 60,000. So 48,000 in year one. The other 12,000 gets spread out over the next 15 years or 14 years, excuse me. Mm-hmm. And so, like I said, it's just accelerating it at even a faster rate. And so it's a great opportunity. If you own real estate right now and you're paying taxes, I would look at doing some cost segregation because the tax laws are so favorable for real estate investors right now.
This is huge. Don't give the government any more money than you have to. And if you're in real estate and you're listening to this right now and you've not done a cost seg study, call Erik. Go to his website, costSegAuthority.com. Erik, it's been a pleasure having you on the show, my man.
All right. Thank you. It's been a pleasure.
Hey, see ya.
See ya.